Hello investors, welcome to Business Learnings. This video is for those retail investors who want to generate better returns than the index fund, but they do not have enough time to shortlist a good mutual fund, who do not have enough time to shortlist good stocks and keep following them, keep consistently following them throughout all the quarterly reports, go through all of the annual reports, attend the conference calls, who simply do not have enough time to do that. So what's the easier way to get that done? Is there an easy way? The answer is yes, there is an easy way, and the easy way is often the most difficult one in the world of investment because people tend to overcomplicate things. I'll probably talk about the investment psychology in another video. This video is not about that. This video is about a strategy so that you earn better returns than the index funds at zero expense ratio, almost zero expense ratio, because there will be some transaction charges, STT and all, at significantly lower risk, lower volatility than the index funds, and a significantly better returns than the index funds. So the strategy is coffee can investing. It simply means buy and forget. So in the United States, how did this name emerge? How was this name coined? In the United States, back in those days, 30-40 years ago, when people used to buy stocks back in those days, they used to get share certificates. They used to store those share certificates, they fold it and put it in the coffee can and just forget about it. After a decade or so, when they took out those share certificates and checked out the price in the market, they found that the stock has grown by 5 to 10 to 20 times. So yes, it's possible. The strategy is as simple: keep on holding. But you cannot hold any stock and expect to get a 10 times, a 10 bagger on that stock. You will first have to do some kind of filtering. So what kind of filtering? I'll talk about that. In India, if you have heard of Marcellus Investments, or especially Saurabh Mukherjee, who is one of the proponents of coffee can investing in India, he simply devised a 2-parameter filter which eliminates a lot of bad companies, which eliminates your inconsistent performance, which eliminates your cyclicals, and focuses only on good stocks. What are those 2 parameters? First is revenue and second is ROC, return on capital employed. I'll get into the details of both. The first parameter of revenue says that the company should be growing its revenues by 10% every single year for the last 10 years. So this does not mean that the CAGR would be 10%. This means that every single year the company's revenues should be growing by at least 10%. Right? Parameter 1. Parameter number 2, return on capital employed. Since a lot of investors tend to ignore this parameter, return on capital employed, I'll try to explain what it is and then I'll talk about the parameter. Okay. Suppose you start a business, you decide to start a business, you put 1 lakh rupees of your own capital. You feel that 1 lakh rupees is not enough, so you go to a bank, you borrow 1 lakh rupees more and put it into your business. So your total capital becomes 2 lakh rupees. Next year, your profit, your operating profit, it's about 50,000 rupees, and from that you will pay your taxes, you will pay your interest to the bank, and whatever left is your net profit. So 50,000 rupees is your operating profit. The capital was 2 lakh rupees, so 25% is your return on capital employed. Whatever return you earned on the total capital that you had employed. Okay. Now there is an exception to this rule. Banks couldn't be a part of this shortlisting if you just do shortlisting basis these 2 parameters. Why? Because banks run their business on taking deposits. Basically, deposits are like debts, liabilities to the banks. So for banks, you will not see return on capital employed, you will see return on equity, right? So the rule says the return on capital employed should be more than 15% every single year for the past 10 years. It's as simple as that. For banks, the rule will say the return on equity should be more than 15% for the last 10 years every single year. One very important thing, it's not CAGR, it's not compounded annual growth rate, it's every single year, more than 15% ROS, more than 10% revenue every single year. Exception again will be your COVID situation, because a lot of companies have reported a negative earnings. That was because of your lockdown, and that's why for this year you can consider an exception. You can take a discount. You can ignore this year, and you can simply filter basis the revenues and ROC numbers of financial year 2010 to 2019, 10 years. Okay, these two filters. Now let me check my agenda if I have covered everything or not. Yes. Next, I want to talk about where do you find these companies, and second, what else can you do about it. So to build a filter, you can simply go to Screener. You can check out the revenues for the last 10 years, but it is going to be a manual task. You can probably write a Python script and scrape through BSE or NSE's website, but probably some code will already be available. There is an alternative at Screener. They provide sales growth last 3 years, last 5 years, last 7 years. You can probably take that as proxies for individual years, but it's not accurate. Let me remind you that. Okay. So yes, this is this. For the ease of usage of you investors, I can probably run a Screener demo on my YouTube channel sometime. If I get more than 50 likes on this video, I'll probably do that. Now, second and the most important part, first was this basic screening. Second was, you are not simply going to get whatever companies that filtered out that you got from this screening of 2 parameters. You cannot simply invest, you cannot blindly invest in these 2 parameters. The companies that you got basis these 2 parameters, you have to do the corporate governance check, and that's the most difficult part. How to do the corporate governance check? It's a separate video in itself. There are a lot of factors that you want to consider. There are a lot of red flags that you get when you read the annual report, and probably it's out of scope for this video, but again, if I get enough number of comments, I'll probably cover that also in some other video. So yes, corporate governance and clean books are the parameters that you finally want to filter based on your short list of companies on ROS and revenue. So this was all about Coffee Can Investing. If you liked the video, please hit the like button, subscribe, press the bell icon, and support me. Yes, so this was all in my agenda. I'll try catching up with you all next week, probably on some other video, or probably an extension of this video. Thanks a lot for watching this far.